Chapters 4 and 5. Chapter 4 is the accounting cycle. So this one we're going to introduce an end of period spreadsheet to assist us in recording the adjusting entries. We are also going to introduce a classified balance sheet. So a classified balance sheet is dividing the assets into two sections: the current assets and property, plant, and equipment, and then liabilities are divided between current liabilities and long-term liabilities. So current liabilities are any assets that are going to be converted to cash, sold, or used up within 1 year. So they're cash, what you're going to turn into cash, and in the examples here on the slide, both the notes and accounts receivable is going to be turned into cash in the next year. And then you're going to sell, that would be inventory, which in this case our example Net Solutions is a service company, so it does not have inventory. And then we're going to use up the supplies and other prepaid expenses. So notes receivable, as I indicated, are written promises. They're a little bit more formalized. They're an actual legal document, a promissory note that is written out with traditionally terms as to what the interest rate is to be charged, what is the term, how many months do you have to pay this note off, and what would be the monthly payments. So property, plant, and equipment are fixed assets. These are tangible fixed assets, include equipment, machinery, buildings, computers, and the like. Current liabilities are liabilities that are going to be paid off within the next year. And they include notes payable. That's the opposite of your notes receivable. So this is also a formalized promissory note, only this time you're the debtor, the one paying the debt. Accounts payable, wages, interest, taxes, and the unearned fees. Anything that's due and payable beyond that 1 year is going to be a long-term liability. And then stockholders' equity is the accounts, retained earnings, and the common stock. So we're going to have the accounting cycle to complete that is going to have, we're going to use the chart of accounts, journal entries, an unadjusted trial balance, and the end of period spreadsheet. So make the adjusting entries, come up with the adjusted trial balance, then produce the financial statements, and then closing entries to remove and zero out any temporary accounts. These are primarily dividends, revenues, and expenses. So our new expanded chart of accounts is this. We made journal entries throughout the month. These are chronological in nature. So we have, we contributed cash, some accounts receivable, some supplies and office equipment in exchange for common stock. We bought some rent, prepaid multiple months of rent, bought an insurance policy, received some deposits from customers for services to be provided in the future. We then bought some office equipment on account, did some further work getting paid in cash, paid some miscellaneous expense, paid down some of the accounts payable here when we bought the office equipment, build out some additional services that we have completed for fees earned, paid salaries, received some cash in exchange for services provided, bought some supplies, build out some more fees that we have earned, receive some cash in exchange for services, receive some cash payments from invoices that we have previously sent out to our customer base, paid salaries once again, paid some additional miscellaneous expense, and then some more miscellaneous expense on the 30th, received some cash in exchange for services provided, sent out invoices, and then lastly paid some dividends. So once we posted all of those journal entries to their various accounts, we come up with this as our unadjusted trial balance. We then use a spreadsheet, and what the spreadsheet does is list out all of those unadjusted trial balances with room down below to create new accounts, in this case from row 22 through 25. We have new accounts that previously weren't debited or credited during our chronological recording of business transactions, and that's rent expense, supplies expense, depreciation, and insurance expense. So we add those new accounts, and then we do adjustments, and we do this all in a spreadsheet. So the adjustments are, we have $300 worth of expired insurance. We determined that we had $1,350 worth of supplies that were unused out of the $2,200 listed on our unadjusted trial balance. So that means we used up $850. The depreciation on the office equipment was $330. We have salaries due and payable but not yet paid of $120. We have now expired $1,600 in rent. We have earned $2,500 of the $5,000 in unearned fees, and those are journal entries A, B, C, D, E, and F. And that's what's here. You can see A is insurance expense, reducing it by $300. B is the $850 worth of supplies, going to supplies expense. C is the depreciation. D is the salaries that are accrued and now payable. And then E is the rent expense that expired. And then F is the $2,500 worth of fees earned that are now earned from the deferred revenue that we had. So this gives us the adjusted trial balance. That's these columns F and G out here. And from that, we can produce the financial statement, the income statement, the statement of retained earnings, and the classified balance sheet. So you can see cash, accounts receivable, supplies, prepaid rent, and prepaid insurance, or what we're going to have as cash, going to turn into cash, going to sell or use up in the next year. We have long-term tangible assets of office equipment. We have current liabilities of accounts payable, salaries, and unearned fees, and then the two stockholders' equity of common stock and retained earnings. So that's the spreadsheet. So we start with the unadjusted trial balance. We enter that in. We then enter in the various adjustments, and then we add or subtract those adjustments depending upon what the balance was. So if the balance was a debit and we made a debit adjustment, as in the case of accounts receivable, we're going to add those two debits together. In the case of supplies, we started with a debit balance, but we made a credit adjustment. So we're going to subtract that amount. Same with prepaid insurance. The accumulated depreciation just has one entry, as does wages payable. Unearned rent started with a credit balance, but we made a debit adjustment, so we're going to subtract that amount. Fees earned had a credit unadjusted balance, and we made a credit adjustment, so we're going to add that. Wages and supplies both had debit adjustments and debit balances, and we made debit adjustments, so we're going to add those two amounts. And then all of these accumulated depreciation, wages payable, rent revenue, insurance expense, and depreciation expense all had a single entry, and so we just carry that balance over. That gives us our adjusted trial balance. We can then break that out between the balance sheet account and the income statement account. The difference between the two columns in income statement, the total of the credits is all the revenues, the total of the debits is all the expenses, and the difference between that is net income. So all on this one spreadsheet, we have separated out the two primary financial statements, the income statement and the balance sheet, and we have calculated net income on that sheet. So that's the end of period spreadsheet, and I'll be doing examples out of the back of the books to demonstrate that. Then Chapter 5, we talked about an operating cycle, because the definition of a current asset and current liability is 1 year or an operating cycle, whichever is longer. So an operating cycle is when you first start spending cash. In the case of a merchandising retail business, so you're buying merchandise, gets shipped to your store, then you sell it either for cash or accounts receivable, and then you collect the accounts receivable and back to cash. The time it takes from when you first started spending cash to coming back. The other thing in Chapter 5 we're going to introduce is the multi-step income statement. So service businesses is what we've been doing in Chapters 1 through 3. A merchandising business adds an account called cost of goods sold. Cost of goods sold is the direct cost of merchandise that you in the case of a merchandising retail business, that you purchased and then put on your shelf to sell to your end customer. That gives us the first of the multi-step, which is a calculation of gross profit. That's the direct profit you make on the sales of your merchandise. From that, you subtract operating expenses, and that gives you operating income. So the cost of goods sold, as I said, is the cost of merchandise that is sold. Any merchandise that is not sold is a inventory, what is left over on the at the end of the period. So the multi-step income statement starts with sales, subtracts the direct cost of those sales to come up with gross profit. We then subtract operating expenses to come up with operating income, and then we add or subtract any other revenues or expenses. These are extraneous to our core business. They include interest income or interest expense. They include rent revenues, gains and losses on the sale of fixed assets. So that would go under other revenue and expenses to come up with net income. So income from operations is operating income, normally broken out further between selling expenses and administrative expenses. Selling expenses include salaries, store supplies, advertising, delivery expense of your sales. Administrative is office salaries. Insurance expense is normally general. Depreciation of office equipment and office supplies that are used. So other revenues are not related to the primary core business. Include, as I said, income from interest, rent, gains from the sale of fixed assets. They also include interest expense or losses from the disposing of fixed assets. So here's our net solutions income statement. We have sales of $708,200. 225 less gross profit, cost of goods sold of 520,305 gives us our first calculation in the multi-step. The first subtotal of gross profit, 187,950. We have 70,280 in selling expenses and 34,890 in administrative, for a total of 105,710. Subtract that from gross profit, we get our second subtotal of operating income or income from operations. Either one is a correct term. 82,240. We had rent revenue of $600 and interest expense of $2,440 for a net of a negative 1840, bringing us to net income of 80,400. And then the classified balance sheet has current assets, and this now includes inventory. So remember, current assets are classified as cash, what you're going to turn into cash, what you're going to sell, and what you're going to use up during the coming year. Property, plant, and equipment included land, store equipment, and office equipment. Current liabilities, everything that's due and payable in the next year or a operating cycle, whichever is longer. And then the long-term portion of the note payable, what's due beyond the year, is $20,000. And then our stockholders' equity with common stock and retained earnings. So that's it for chapters 4 and 5.